The Federal Reserve has finally started to raise interest rates. However, in the last 12 months, inflation in the US has gone from 4.2% to 8.5%. And the White House is hell-bent on trying to crowbar the new term Putin's price hike into the modern psyche in an attempt to convince us that it's that rather than the horrendous mismanagement of monetary and fiscal policy that is responsible for the new inflation problem. For all this and more, I'm joined this week on Goldcore TV by Lobo Tiggre of the highly regarded newsletter, The Independent Speculator. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to Goldcore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. Lobo Tiggre, welcome to Goldcore TV.
Glad to be here, Dave.
Now, April 2021, we had inflation in the US at 4.2%. The most recent inflation figure that we've seen out of the US is 8.5% official. Now, we've seen one hike out of the Federal Reserve, and there's more priced in, but effectively inflation is going up at a greater rate than we're seeing interest rate hikes. So in reality, real interest rates are really going lower. What could go wrong?
It's an excellent question. I wish more people would ask it because, it seems like gold bugs, and I am one. I stack my silver and gold bullion like all the rest of us. We just want cheerleaders to say, yeah, it's going to the moon. And I am bullish. I do think it's going higher. But of course, things can go wrong. And in this particular case, it's important that a change of direction can have a big impact, particularly on the traders, on the COMEX and places like that, where we get these futures contracts prices that we, I think, mistakenly refer to as the price of gold or silver. I mean, these are the market signals. These guys are not you and I who go down to the local coin shop or your business, and buy your physical bullion. These are traders. Some people like to think of them as traders, but we won't go there. Point is, a directional change can be very important here. And if the Fed does its, monster interest rate hike of 50 basis points, at the same time, CPI, we know that inflation is high, but the CPI print won't change at that moment. At that moment where they do their monster hike, it could look like a directional change. And at the same time, you have all the powers that be out there. There's still, even if they've retired the word, they're still pounding the transitory table. They're still talking about, the COVID effects coming off and the war is temporary. All this stuff is transitory, right? So there's an argument, it might be discredited, but amongst Wall Street professionals and, that crowd, it still carries water. There's a persuasive argument that high inflation is peaking or has peaked. It's kind of funny that they said the same thing in December, then they moved the goalpost to January. No, now it's really peaked in February, and now March is blowing everything out of the water. But as long as the mainstream still buys this, they're still drinking the transitory Kool-Aid, even if they don't call it that. So you've got this perception that, inflation is going to roll over and the Fed's going to do something big. So a perception that there is a directional change in inflation, that matters. Markets are forward looking. And so these guys pushing their paper, gold and silver around, they're going to treat that as market data. And you could see gold and silver come under pressure based on that directional change, which of course I would see as a buying opportunity. But, I don't want to be that guy that says, oh, nothing can ever go wrong. So thanks for asking the question.
So what we're saying is we're going to see, like there's even talks at the moment of potentially Bullard is talking about a 75 basis point hike. Now he's obviously an outlier in that regard, or else they're paving the way to actually try and jawbone the market in this direction to accept this. So we could see, because of other impacting forces on inflation, we could see a little bit of a peak and a reduction from that official, and I always coach everything with the inverted commas, official 8.5%. So we could see it come lower, and that gives the opportunity to the market participants to say, okay, well, the Fed's doing what they said that they'd do. inflation
Right.
is transitory.
They're beating inflation. Though I would caution, though, a decrease in the increase, that's not a peak. Like if you're climbing a mountain and the rate of increase, the rate of the, is less, there's a little shoulder in the mountain. That doesn't mean it's the peak of the mountain. It can go right back up again. Or even if it goes up more gently instead of as steep as you're still rising. Your cost of living is not dropping at all. You're
accelerating towards the edge of a cliff. You're just not accelerating at as great a rate as you were before.
You see the traders, you see the talking heads on Wall Street, you see them, they'll jump on any decrease in the increase. Oh, look, it's peak inflation. And then the next month, oh, no, it wasn't.
So, and we're going to get the same reaction, not just in precious metals, but we're going to get an opposite reaction potentially in stock markets. We are going to find, okay, the markets are going to say, okay, the Fed's got this market under control. We're off to the races again in stocks.
That could do. I mean, never say never. It's honestly, Mr. Market has been so psycho lately. He's always been bipolar, but lately some of the reactions have been just crazy. The bad news is good news economy that we're in, or Wall Street economy, has been just on steroids lately. I'm a mining stock analyst. I kick rocks and I look at projects and try to determine which ones have a chance of actually becoming mines. That's really my specialty. If you get into, the mass psychology of traders, that people ask me these things, so I answer, but I just want to qualify here that I'm not actually a Wall Street veteran. So on the one hand, this idea that, oh, the Fed's got this, sure. And by the way, policy is still easy. If you're behind the curve and you've increased, dramatically, the jumbo rate, 50 basis point hike, but inflation is still, pushing double digits. That is easy money. And so that fans the flames on Wall Street to go higher. On the other hand, as we were just saying, directional changes matter. And if it's perceived that the Fed is getting, really tough in the fight in inflation, Wall Street valuations are stretched. Everybody knows it. Nobody wants to be the one standing when the music stops. So it's easy to see those same actions, bursting the bubble.
And markets,
I don't know which way it's going to go, Dave. It could go either way.
Markets are hypersensitive to bad news as well. Like we saw Netflix there lose 25% of its value in the space of 20 minutes. So
I think that's an excellent point. And it's an example of we see this in other things. The way the market keeps going higher, because the context is still easy, is battling this way we see any bad news anywhere, like this instant knee-jerk reaction. We haven't had many of these 1,000-point falls, but 500 or something, that happens a lot. I mean, to my mind, this looks like a very jittery market. It supports this thesis that I'm saying of nobody wants to be left holding the bag. So there is a potential here for a real waterfall event if the plurality of investors start saying, holy cow, this is it.
And we're also getting manipulation of the message around inflation. I mean, it was only in the last week or so that we have the White House coming out and blaming Putin's price hike. I mean, as we said, inflation in April 21 was 4.5%. It's now 8.5%. The invasion happened early. It's over a month ago at this stage. We had inflation all along, and the trend was higher. But now they're trying to present it as Putin's price hike. Very disingenuous, isn't it?
Absolutely. And it's another example that the goalposts keep moving. If you recall, before April 2021, that was supposed to be the peak, actually, originally, because that would have been a year after the great COVID shutdown of 2020. So you would have had the base effect. You had actually disinflation. You had negative CPI in that, tiny little 1 month blip after the immediate shutdowns. So of course, a year later, you have high inflation. And that was, the year-long base effects were supposed to come into effect a year ago. And here we are twice higher. So then after that, oh no, well, it's the next wave. And then it's supply chain disruptions. And then it's Omicron. No, it's new supply chain disruptions. And now we've got the war. In his last testimony before Congress, Powell really, before the rate hikes, he laid the ground. The war is a great excuse. This is the latest transitory, even if he didn't use that word, impact that's going to explain why inflation is going to be a little bit higher for a little bit longer. And you know what? It could be that March actually was the peak. But until you see that chart change, right, it makes no sense for these guys to run around saying all the time, oh, it's the peak, here's the new excuse. And it's beyond me how serious investors, people moving millions of dollars around, will listen to these guys who are perpetually wrong. I just how to explain Mr. Market psychosis? I can't do that. It's above my pay grade.
Now, as you say, this is not happening in a vacuum. There's an awful lot going on in the world at this moment in time, and nothing greater than the war in Ukraine, both from a human point of view, but also from a financial point of view and a geopolitical point of view. We've had a situation now over the last month or so where the West has basically started to weaponize financial assets and weaponize dollar assets. What could possibly go wrong with that?
A variety of things, but actually this is a good opportunity to kind of step back from the investment thesis here and remind everybody, you know this, you don't need me to tell you this, but I think at this time it's important to really focus on the fact that, or not the fact, in my view, silver and gold, physical bullion in your direct possession, that's not an investment. It's not, I don't speculate it. I don't buy physical because I think prices are going higher. I buy it because it's physical gold that I can have. And if the balloon goes up, things get really bad, it is a financial asset for which there is no short. There's nobody else's liability. It's something that I can use in case of emergency. And by the way, I've actually had that experience in my life where as the ultimate refuge, I've had to cash in bullion in a financial meltdown I had around Y2K. So I know what it's like. And I sleep better at night knowing that I have that. And I don't want to sound like a prophet of doom. I'm not saying that this is going to spill over into World War III. But the fact is, I think we are closer to World War III than we've been in decades. We're talking about, even mainstream media are talking about the possibility of tactical nukes being used in Ukraine and the potential spillover from that. How do you keep the radiation from blowing out of Ukraine? You don't. I'm not saying that World War III is upon us. I'm just saying that in a world where we're even thinking that it might be an inch closer, that is a world in which I want the security of physical gold and silver in my direct possession. It has nothing to do with all this talk of inflation and economic fallout and where prices might go. I just want to have it in case I need it. But in terms of the economic fallout, I'm no fan of Putin's, but he's not wrong when he says the West is waging economic war on him and Russia. And we could talk a long time about this, Dave, but the short version is that we are seeing the building of a new Iron Curtain. This has huge economic implications. At the very least, it makes the global economy less efficient and it makes prices go higher. So we're looking at permanently higher prices, cost of living, which feeds back into the inflation question. Basically, this is a non-transitory, long-term push for higher prices globally. That's bullish for commodities prices. It's bullish for monetary metals in this scary world. So I think you've got, the economic situation is bullish for metals as commodities. And you've got the fear factor from the war, the safe haven demand is also bullish for gold and silver at this time.
So we're seeing kind of a trend, or the potential for a trend of deglobalization to emerge here. That's been brought on by a number of things. One is as a result of COVID-19, but then also the second one is as a result of the war in Ukraine, and how that has highlighted to a lot of countries and a lot of governments that there's a heavy dependence on energy from Russia, for one, but also on food, grains, other commodities, and by default, rare earths, and
everything. Yeah. No, this is a big deal, and you're right that it didn't just come about suddenly because of the war. People were already thinking about this. Really, it's never not been on the table. People have been aware of this for a long time. But when Trump really ratcheted up the rhetoric and the economic battle with China, and that's really when people started realizing how much we depend on China for many things, not just cheap stuff in Walmart, but like rare earths that go into these magnets for the electric cars and other things. So there is, I don't think this is just you and I saying there's a theoretical possibility. I think this is a visible trend in motion where countries around the world are suddenly getting religion saying, oh, wow, we need independence. We need our own sources of raw materials. We can't just outsource all that to those brown people over there. So that's, it is bullish for extractive industries in first world countries that have exported all of that stuff. It's bullish for metals, commodities at large, but it's again another factor into this, deglobalization. Why did globalization happen? It made things more efficient. And if you're deglobalizing, you're making things less efficient. So yes. Again, here's another factor of higher costs, not transitory, not going away. And that inflation genie, I think, is well and truly out of the bottle. And it will be years sorting all this out. And, by the way, even if the war hadn't happened, we would still be years sorting out the COVID situation. You can't just turn off the motor of the world like John Galt and then flip it on again and think nothing broke in the dark. Everything's going to be fine. We're still dealing with chip shortages and all that a couple of years down the road, and it hasn't stopped. The globally interdependent economy was a fragile thing, it turns out. Nassim Taleb, right? We were not anti-fragile. And now you throw a war on top of that. A war that's not over yet and could get worse. Again, I'm not trying to fearmonger. I'm not saying it's the end of the world, but you can't ignore these possibilities. So in this world, I see owning physical bullion as an absolute necessity for security of my own self, my family, those who depend on me. And I see a world in which all the trends point towards higher commodities prices, and the government responses to these things are inflationary. And I think that's very bullish for monetary metals, short-term fluctuations aside.
And to put you on the spot for a moment, if you were sitting in Jerome Powell's seat.
Oh, not that spot. Okay.
Nobody wants to sit in that seat. What would you be doing?
Well, my immediate inclination would be to resign. I don't want to be in that. I mean, really, why did he want that job again? I don't know. Maybe people.
Thankless task, really, isn't it?
There's no
impossible task.
Yeah, no, I don't. There's no soft landing here. The circumstances are such. I don't see any way anybody comes out of it. But if I got that bully pulpit, I guess I would try to educate as much as I could before they sent the firing squad to get rid of me and silence me. I would say the Fed was a big mistake. Hey, I'm the chair of the Fed. Let's audit the Fed. Let's bring back Ron Paul's idea. Let's audit the Fed. Hey, let's have a look inside Fort Knox. Is there anything actually there? I remember Ben Bernanke, vein pulsing in his forehead saying, oh, we only have the gold in Fort Knox for tradition. Yeah, right, tradition. Maybe there could be a few things I could do before they gag me and hold me off screen that might be useful. I'm being tongue in cheek here, but I'm actually being quite serious. I think that might actually be the most useful thing I could do. What policy? The correct policy would not be, oh, it should be this rate or it should be that rate. The correct policy would be to let the market determine rates. And I wouldn't have the power to do that, but that would be what I would say. Okay, let's let the market determine interest rates. And of course, that would create, a collapse. So my head would end up on a pike anyway. But I think postponing the collapse only makes it worse.
It's kind of what we had. What happened after 2008?
Also very hard to participate. Exactly. You kick the can down the road. If we had embraced the pain in 2008, would there have been, Mad Max consequences? Possibly. Even a free market advocate looking at that, am I really going to be the person that pushes the world into a new dark age? Maybe you compromise that. I don't know that I could. I'm known for being an obstinate stick in the mud, rain on the parade, kind of no fun guy. So yeah, I'd pull the plug on the party. And if, I would say, let the market decide, let the chips fall where they may. And probably before I got to that second phrase, I'd be hauled off stage. But if I got that far, and it wouldn't happen, but if it did, ultimately that that I think sets the stage for a better future. We're getting a little philosophical here, Dave. But
ultimately a return to free markets, or just to have truly free markets.
Yeah,
let the market decide.
Has to happen sooner or later, and the later it happens, the more painful it will be.
Yeah. Now, obviously, you've talked about physical gold and silver as a way to protect people going into the future, a very uncertain future, and becoming more uncertain in the last couple of months. You're obviously heavily involved in looking at the mining sector. Maybe you might talk to that for a moment, what it is exactly that you do on that side of things.
Well, again, I hold physical as security, right? That's my savings. It's not a speculation or an investment, but I am a speculator, and I do think prices are going higher. And it's well known that, and it's not just gold and silver, but any sort of mining or resource company offers leverage to the underlying commodity. If the commodity goes up 1%, it's common to see gold and silver miners go up 3, 4, 5%. Right? So if you think gold's going to go up 20% this year, 3, 4, 5% like that, you're looking at a double in the stocks. So I want to save in bullion, but to earn money. And I'm still at a phase in my life, my beard's turning white, but I'm still at a phase in my life where I'm looking to earn wealth rather than preserve wealth. And to maximize earnings, I think disciplined speculation in the right commodities companies at the right time, get the trend right. That's the speculative part, is getting the trend right. And then you have stock selection. I think it's very dangerous to just buy an ETF in these spaces because they have the good, the bad, and the ugly in there. And there is a lot of bad and ugly in there. I think it outnumbers the good. My hat for a long time has been kicks rocks, picks stocks. That's what I do. Try to offer guidance to those who want to do the same.
Okay. And where can our viewers find out more about what it is that you do?
Independentspeculator.com. Of course, I hope people want to do business with me, but the quick, easy thing to do is to sign up for our free weekly digest. I promise we will not spam you with a flood of daily advertisements. If you sign up, you get one email. You can see how I think, see what I write about, see what I'm doing, and then see if you want to do business with me.
And you're active on Twitter as well, I believe.
Yep, Due Diligence Guy at Twitter is my handle there. I forget what I am on LinkedIn and Facebook, but I'm there as well. Probably most active on Twitter. On a daily basis, I share thoughts about markets on Twitter. And then there's that weekly digest for people who don't want to go there.
Right. What I'm going to do is I'm going to put a link to your website for people to sign up for your free newsletter, and hopefully a bit more. And also put your Twitter handle as well down in the show notes below. So anybody that wants to follow up with Lobo, please, I would definitely advise you to do that. But for now, Lobo Tiggre, thank you for joining us on Goldcore TV today.
Thank you so much. An interesting conversation.
Thanks for watching. And if you enjoyed this video, make sure you check out this interview that I did with energy expert Steve St. Angelo on the deepening energy crisis in Europe and globally. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to Goldcore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.